Interest rates, are they going up? Are they going down? And what should you do? Should you wait to buy or should you get stuck in? Financially, what's the best approach? We are going to compare 3 different scenarios: rates falling, rates rising, rates staying the same, capital growth in the UK over the next 5 years, average predictions, higher predictions, and we'll bring all of that together to see what the financial picture looks like and hopefully help you answer, should you wait until rates fall or we have more clarity, or should you simply get stuck in and start buying now? If you haven't already, make sure you like and subscribe. It really helps the channel and I really appreciate it. If you've been unfortunate enough to read the news recently, then you're probably pretty unsure as to what is going on with interest rates. On one side of the fence, they are going up 6%, according to this article here. And on the other side of the fence, they are falling this year. So if you are thinking of buying property in the UK, you are naturally going to be thinking, should I wait until rates are more clear? Should I wait until they fall? And what is the cost of doing so? So today, I'm going to compare 3 scenarios and run the numbers to show you exactly which is the most profitable approach. Wait or buy now. What's the best approach? With most things in property, it depends on your goals and your situation. But if your goal is to get stuck into buying property and building wealth with property as soon as possible as an expat, then you should be looking to buy property as soon as possible. So as I say, let's jump into 3 different scenarios, looking at the different approaches, what each one will cost you, the opportunity cost of waiting, and therefore which approach to take. Why then are interest rates so much of a factor when it comes to buying property? Obviously, the Bank of England uses interest rates to control inflation. When we've got increasing or inflationary pressure, as we do at the moment with the price of oil and the war in the Middle East, the bank raises interest rates, which pulls more money out of circulation in the economy. Why? Because it puts up most people's largest expense, their mortgage, taking cash out of circulation, and it makes savings more attractive. As an expat, this is amplified often because A, you're further away from home and it's a little bit scarier, but you're already dealing with currency exposure potentially if you're earning in dirhams, Sing dollars, or Thai baht, for example. As an expat, you've got a small premium on the mortgage products and the rates. You're probably paying 0.5% up to 1% in some cases more than a UK resident. So these interest rate changes can be felt more by us living overseas. I know I've built a portfolio in the UK and in other countries, so I know what the impact of a rate change can have on property prices and underlying cash in your pocket. And I think the key question here is not will rates go up or will rates fall, but what will, for me, the cost of waiting for rates to come down to a level I'm comfortable with, what will the real cost of that be in monetary terms? So let's put some numbers on it across 4 different scenarios to help us try and actually make that decision. I'm going to be using a £200,000 property. I know that's below the UK average, but that's been about the value of most of the properties I've bought, so I quite like the number. I quite like to target a 6% yield, which is £12,000 a month. That'd be nice. £12,000 per annum in incomes of £1,000 a month. They're nice round numbers. And like I say, a lot of my properties fit that bill. So on top of that, we're going to take a 75% LTV. That's a loan to value on an interest only mortgage. So what does that mean? We've got a £150,000 loan. So our interest rate exposure will be on interest only and on £150,000. So what does it look like? Now, before we get into the 4 different scenarios, I just want to maybe help you think or make you think by giving you a number. And that number is £16,870. Now, what is that? That's the price of a pint of milk in the UK by the end of the year. No, that is the difference between the best case and the worst case scenario in my example on interest rates. And that is over a 5-year period, which yes, may seem like a lot of money, but I think as well, if you're thinking of holding off, you are missing out on potentially what you could be getting in terms of gain and return from a £200,000 property, which we'll come on to. So let's have a look at the numbers. So if rates stayed the same, and you've got to remember we've got conflicting opinions. In the second article I mentioned earlier, the UK's growth forecast has been upgraded from 0.8% to 1%. So that's where you may have to cut rates is coming from. And then post the last vote, you had that GB News article I showed you saying 6 increases, which I think is rubbish, but let's have a look at it. So currently we're at 3.75%. These are the Bank of England rates, not mortgage rates. For simplicity, that's what we're using. On a £150,000 loan, your repayments will be £469 a month. That's 5,600 odd over a year. and 28,000 over 5 years. Right, best case then, rates are cut. We've gone down to 3% for this, so that would probably be 3 cuts, 3.25% cuts. Monthly then is 375. Quite substantial. Annual 4,500 and over 5 years 22,500. That is a difference of £5,625 on where we are now over 5 years, so about £1,000 a year. And you'll notice the changes, because we're on interest only, the changes, so the gain, the amount you save when you go down will be the amount you pay when you go up, because it's the loan size is staying the same and the increments of interest change are staying the same, if that makes sense. Moderate rise then up to 4.25%, so that would be 2 increases, say. Your monthly payments, 531, your annual payments, 6,375, and your 5-year payments, 31,875. That would be on an increase from today, or the baseline of 3,750 extra. Okay, worst case scenario, 6 rate increases. Up to 5.25%, which is where we were before the current cycle of rate cuts started, and it was continuing to head down before the war, but there we go. So £656 per month, that would be 7,875 over a year, and 39,375 over 5 years. So that would be an increase from the current rates over 5 years of £11,250. So if you're simply waiting on that and you're not thinking of the full picture, then you probably think, okay, let's wait and see what happens with rates, because best case, I'll save 5,000 odd pounds. Worst case, I'll be out of pocket 11,000 odd. So 16 grand swing. So definitely wait. But is it the full picture? No. Let's have a look at property prices. And this, I think, is what a lot of people forget, is that regardless of what's going on with interest rates, you have property prices to take into the equation. And I know changes with interest rates will impact property prices. So what I've done is I've taken Savills' most recent house price predictions and their UK average of 22.2% growth over the next 5 years. I've then taken a middling number from the East Midlands at 24%, and then I've taken a higher value, not the highest, I've used Scotland at 27%. Again, the parameters are the same, £200,000 property. What will the increases in values be over 5 years? So the UK average, you're going to have a property valued at £244,000. In the Midlands example, you're going to have a property valued at 247, almost £248,000. And in the higher value example in Scotland, £255,000. So your gain across the board here is between £44,000 and £55,000 over 5 years. And perhaps now you're starting to get the picture. When you look at the full picture, the image changes. Let's just look at the worst case example and say rents did go up and that cost you 11,000 odd quid. If you took that off your property price, which I know you can't really do, but we're looking at numbers on paper and talking about building wealth, then you would still be net positive £33,000 to £44,000. Even in the absolute worst case scenario. 6 hikes taking us up to 5.25, back where we were, you'd pay £11,250 more in mortgage costs than now. Property grows by 44 to 55,000, which means a pretty large net positive. Thirdly then, I think we need to consider as well the missed rent potential, because that's what's going to give us the full equation, right? And you must remember, if you are buying a property, you have a tenant in it and they are paying your costs and your mortgage, even if it increases. And that's why you've got to buy well, try and target a higher yield, because that means even if rates go up, your interest, your mortgage and your costs are going to be covered. So the opportunity cost on a rental perspective of waiting, we're using a 6% yield. So that's £12,000, £1,000 a month. So if you wait 6 months to see what happens with rates, whether they go up or down, that's £6,000. 12 months, £12,000. 24 months, £24,000. 3 years, £36,000. 5 years, £60,000. The average property, depending on where it is, goes £44,000 to £55,000, plus your £60,000 in rents. You're looking at potentially £100,000 of unrealised gain in rents and property values increasing because you waited to see what happened on mortgages, with the worst case scenario on mortgages being having to pay £11,000 odd more over 5 years. I mean, does it really make sense? So let's just take the number 1 year and have a look at across the averages of what the opportunity cost of waiting for 1 year would be. Let's take 2% growth, which is what Savills are saying in 2026. So not 5 years, just the 1 year. On £200,000, that's £4,000. Missed rental income, £12,000. So £16,000 gone there. Worst case example, on the cost of the mortgage, if it goes up 6 times, it's going to be about £2,000. You could have earned £16,000 or increased your wealth £16,000. And even in the worst case, you would lose 2 with mortgage rates going up. So 14 net. So should you wait? I don't think so. A couple of other things to consider alongside that if you are an expat, and we can do another video podcast on that. Currency risk, currency fluctuations. What currency are you getting paid in? Is that weakening or gaining against the pound, and therefore is UK property becoming less or more expensive relatively? The rates debate, in my opinion, is taking away from the real question, which is A, what are your goals? And B, is the property cash flow positive now? And will it be cash flow positive stressed up and stressed down? If it is, buy it. Renters Reform Act and changes in tax recently, meaning more and more landlords are leaving the market. For me, this is an opportunity. It means less landlords providing good quality property and a gap for us to fill. What does this mean then? Let's summarize it. For me, the data shows and the figures show that if a property makes sense now, based on numbers now, then it makes sense to buy it, because the opportunity cost of not doing so will cost you potentially tens of thousands or hundred thousands of pounds, regardless of interest rates. Because, as we know, time in the market beats timing the market. These are a couple of things I would be focusing on and do focus on with my own portfolio. Number one, the property must work today on today's rates with some headroom if rates were to go up. If you get a fixed mortgage for 5 years, then just do it based on today. Number two, focus on the asset itself. Are you buying something quality in a quality location with strong fundamentals, population, infrastructure, demand? If it's a good location, then it will go up and do well over time. Number three, the longer you wait, the more prices go up and the more opportunity costs you miss in terms of rents, property values going up, these sorts of things. And as with property and anything like this, things can change. Wars might start, governments might change, as we've seen. Interest rates might go up, which would impact growth. Growth would probably come down then. But even if you stress test those growth figures way down, even if you half them, the figures you're making are still going to be positive. In summary then, what does it look like? We've compared 3-4 different scenarios on rates going down, staying the same, going up, and going up even more. We've looked at the most recent Savills data to look at what house prices will do, and then we've looked at rents as well and the opportunity cost of all of that together. As it stands, rates are at 3.75%. We will see on the next meeting next month, I believe, what will happen. I believe held or potentially an increase. Savills forecasts are suggesting the UK average of 22.2%, with some areas a bit lower, others much higher. We've seen that waiting costs for 12 months, and these are, yes, simplified figures, would be £14,000, and then we've looked at the 5-year and seen that the opportunity cost is going to be into the tens of thousands of pounds of waiting. If you want help running the numbers on a specific property or understanding if it's going to be cash flow positive for you, then I will put a link down below to a spreadsheet I use to A, assess a deal, B, assess it over time, and then C, if you want to go into more detail, you can grab a copy of our book as well, the Expat Property Playbook.